Over the past month, I've been able to take out $45,000 of payouts from prop firms using this one extremely simple strategy. If you've ever been overwhelmed by an overcomplicated trading strategy, I'm going to show you a very straightforward trading approach that's very easy to implement and very easy to understand. You don't need years of experience to trade effectively. In this video, I'm going to go over a very basic, repeatable strategy that even beginners can implement right away. But first, if you guys could subscribe and leave a like on the video, that would be greatly appreciated. Before we get into the actual strategy itself, I just want to say if you are new and or struggling with trading, a lot of the information out there right now is very overwhelming and very overcomplicated. So what I'm going to do here is give you guys what I have seen consistently happen day in and day out in my trading career that is very easy to see. No indicators are required. It's just if you see these things happen, that usually means that price is going to react in a certain way afterwards. So every single day after I open my charts, before I take a single trade, there are two very simple things that I look for every single time. First one being rejection candles, also known as liquidity sweeps, and the second one being the current trend direction. If you have no idea what a rejection candle is or what a liquidity sweep is or what the trend is, let me show you a perfect example right here where we can break it down very, very simply. So put very simply, liquidity is just unfilled orders above a high or below a low. So for instance here, a lot of people are going to be putting their stop losses above this high right here. So there is tons of liquidity above this high that's been created, and same thing with this low or this low here or even this low here. Any peak or low that has been created has unfilled orders above or below it. And the whole idea behind a liquidity sweep is those unfilled orders are driving price in that direction. So in order for the price to continue, it has to first get rid of unfilled orders in the opposite direction before it's able to continue on with its current path. So what I'm going to do now is look for areas of liquidity that can potentially be taken out during my current trading session. So what I'm going to do here is take out the horizontal ray tool, and I'm going to mark off this high as an area of unfilled orders above it. And then I'm going to start marking out lows because all of the highs have already been taken out. So I'm going to mark a low here. I'm going to mark a low here. And then I'm going to mark another low here. And then there's more liquidity further down, but we're not going to worry about that. We're only going to worry about what is immediately present to us for this specific trading session. So now that I have liquidity mapped out on my graph, I'm going to start looking for my rejection candle that's going to signify that we are ready to continue on with the current trend. So as you can see right here, I'm on the 30-minute graph. In the high time frame, we're on a pretty significant uptrend as of recently. So my first instinct is that I'm going to continue looking for longs. But before I'm able to enter in any longs, I'm going to look for a rejection candle that is also part of a liquidity sweep. So at the current time for this trade, it's right around 8 a.m. So it's a little bit before market open, and it's before volatility and volume are really starting to ramp up. So there isn't going to be a ton of really good price action right now at 8 a.m. So we're going to have to move forward until we actually start seeing a little bit of volatility and volume. So I'm going to skip ahead to 8:30. And then now 9 o'clock, and then you can see right here 9 o'clock we're starting to get a ton of volume and a huge downswing here. And as you look at this huge red candle that's formed, you can see that we actually took out an area of liquidity that we had previously mapped out. And in doing so, we are seeing a rejection candle with a very big wick. This wick is approximately 30 points, which is very, very big for a candle wick. So this is signifying to me we might be ready to start looking for long. But before we actually enter into a long, we need confirmation that the trend is actually moving in our favor at this current point. So what I'm going to do here now is that we see high time frame, we are trending up. We have our liquidity sweep. We have our rejection candle also. So now I'm going to go to the 1 minute time frame and start looking for signs of an uptrend that's going to signify to me that this liquidity sweep was valid and that we are going to start trending upwards, heading towards this liquidity up here at 25,755. So we have the high time frame trend on our side. We have our liquidity sweep. We have our rejection candle. Now all we need is a low time frame continuation of our upward trend, and that is going to fully signify to me that we are ready to enter in this trade and take a high probability entry. So the only criteria that we really need for a trend reversal is for a new trend to start. So obviously a downtrend is going to have lower lows and lower highs created just like it has here. And then an uptrend is going to be signified once there starts becoming higher highs and higher lows created. So you can see here that we already have a higher low created compared to our prior low. And if you actually zoom in here, you can see Two 1-minute rejection candles have actually formed right here, which are also very good indicators that we are going to possibly flip the current trend direction. So you can see a new higher low has been created. So all we need at this point now is just for a higher high, and you can see that one is already forming right now as we have passed the prior high point with a new point here. So at this point, I think we can officially enter in a long and see how it plays out. When setting my stop loss and my take profit for my trades, I like to use previous market structure in order to set those boundaries. So as you can see here, there's a new low created here, and then there's a new low created here. So I'm going to use either one of these two depending on how risky of a trade you actually want to take. So if you do the most immediate low right here, that is going to be about a 20-point stop loss. And if you move it down here, this is going to end up being about a 40-point stop loss. And then when I'm setting up my take profit, I'm going to go to those prior areas of liquidity that I've previously mapped out. And as you can see, this is the one that I have mapped from earlier in the morning. So I'm going to use that as my goal for the end of the day today. And right here, we have set up a 2.8 risk to reward ratio trade. Or if you want to go for a more aggressive route and potentially have to take multiple entries, this is a 6.5 risk to reward trade. But either way, these are both valid in their own ways. Whether you want to be riskier or less risky is completely up to you and your trading style. Or if you're using a prop firm, it can often be up to their rules determining on what different size trades you're able to take. So just for the sake of this example, we're going to use the safer stop loss here, and we're going to see how this trade ends up playing out with just one contract of NQ. So for this trade here, the risk to reward is approximately 2.5. So if you're risking $100, the profit goal would be at $250. So let's buy in here and see how this trade plays out. And this trade is starting right around 9 a.m. So market hasn't even opened yet. And that volatility is going to contribute a ton to the way this trade actually ends up playing out. Right now we're up right around $500. So at this point, you'd be moving to break even, especially with market open about to happen. Dealing with the volatility of market open, you don't want to be in a place to lose not only all of your profits, but also lose your profits and then get fully stopped out just because of the volatility of market open. So we're up right around $500 prior to 9:30. So that's a solid place to be moving our stop loss to break even. Once the 9:30 open actually happened, it just skyrocketed our trade immediately to profit. So we reached full profit on a good trade all before 10 o'clock in the morning. So now at this point, you can put the trading down and go have the rest of the day to yourself. Okay, so that first example I showed you guys was an extremely textbook, very straightforward way to use liquidity sweeps along with a trend in order to set up a perfect trade. But it's not always like that. And sometimes you actually have to dig a little bit deeper to find the actual way that the market wants to move. So getting into this trade here, this is the very next day, again at 9 o'clock in the morning here. Okay, so just like before, the first thing I'm going to do is mark out my areas of liquidity. So we're going to have to the buy side up here, and then to the sell side right here, and right here. But along with this, it's also important to note that liquidity never expires. So old liquidity is just as valid as new liquidity. So if we go back here, you can see that this liquidity zone right here had just recently been tapped just 1 day prior. So this liquidity here had been swept. And because of this, if the market were to reverse and turn into short here, this would be a valid liquidity sweep in that sense. So getting into what actually happens in this trading day, again, it's right around 9 a.m. If we move to the 15-minute time frame, you can see everything is uptrending. High time frame and low time frame, we are both in uptrends. So there's really no reason to even look for a short. But again, just the fact that this liquidity had been swept is something to take note of, and to always keep in mind that liquidity never expires. So even old liquidity from a week ago, 2 weeks ago, whenever it is, even if it's from months prior, these liquidity zones are just areas of unfilled orders that eventually are going to have to be filled at some point. The market always looks to fill unfilled orders, and that is the whole point of liquidity sweeps. So using this one right here as a perfect example of how liquidity zones never get old, you can see right here we take a liquidity sweep, and then if we move a little bit in the future here, you can see all of a sudden we have a huge rejection candle and then potentially the start of a huge downtrend. And as you can see here, this is our prior high. So we have not formed a higher high, we've actually formed a lower high. And then along with this, our prior low a new low is being formed. So we have a lower low formed, a lower high formed. This is starting to look like the potential start of a downtrend. So from here, if we zoom in to the lower time frame, you can see that low time frame, we are in a pretty significant downtrend. So high time frame and low time frame have now completely swapped into downtrending. And it's all because of this old liquidity that had been taken out from the day prior. We did not continue our uptrend like we thought we were going to. And then once it flipped, you have to be able to flip from longs to shorts just like that. You can't fall in love with longs just because you initially thought longs were going to be the move today. And you can't fall in love with shorts the same way. So even though it looked like longs were going to be the move, once everything started to downtrend, you have to be able to get rid of your old biases and switch to the new ones. So as you can see right here, we're in a significant downtrend. And now all we're looking for at this point is basically for a new lower high to be formed on the low time frame. So it starts building up and you can see a little bit of a rejection candle right there. And then two more like mini rejection candles following it. And this is signaling to me that this is going to be our new lower high that we're creating again to form a downtrend. You need consecutive lower highs and lower lows. We have two back-to-back lower highs formed here along with a lower low. So I'm going to use this to frame up my trade. So just the same as last trade, wherever you want to put your stop loss, as long as you're using some kind of structure, I think that makes it a valid stop loss. So if you want to go to this prior high right here, if you want to go to this prior high, this one, or the highest one that we have available, these are all valid as long as you're willing to take the risk involved in each one. So for the sake of this trade, we're just going to take the safest stop loss possible, and that is going to be this prior high right here. And then we are going to move our take profit down to the previous liquidity zone that we have mapped out. And this is going to set us up for a 2-to-1 trade. But again, if you were to take riskier setups here, this could be a 3-to-1, a 4.5-to-1, potentially a 5-to-1, depending on how much risk you're willing to take. But anyway, for the sake of this, let's just set our stop loss up for the 2-to-1 trade and let's see how this ends up playing out. So I'm going to sell. We have our stop loss here, take profit here, and let's watch it play out. Off to a very good start here. Once we're up right around $1,000 halfway through this trade, I'm going to move to break even at this point, and then we're just going to keep letting it go. We're significantly in the profit at this point, and we're starting to chop around. I wouldn't be worried during this chop. I'd just let the trade play out, and if it's meant to go break even, it's meant to go break even, but we set this trade up because we believed that it was going to work. So once we have it going, no reason to stop it. And then at this point, about 6 hours in the future, we end up hitting full profit. So this is definitely a much longer trade compared to the other one we were in that lasted just a couple minutes. This one lasted basically the entire day. But again, both trades were very good. Both trades equally as valid too. Just because this one took longer didn't make it a worse trade or a worse setup or anything like that. It's just impossible to control volatility, volume, and the speed that the price action actually ends up moving at. But again, let's zoom out and just recap this trade real quick. You can see our liquidity sweep happens here. You can see our big rejection candle here. And then the downtrend forms once this lower high forms here, and then we get lower lows from then on out. And then that checks all the boxes for us to enter in a short here. And then just a short 6 hours later, we get a full profit trade.